Hello and welcome to another episode of Darwin Investors. Today we're going to be talking about Google, its upcoming 20-for-1 stock split, I believe the valuation will be after the split, and am I going to be buying any of these shares? Does it interest me at all? Spoiler alert, yes, I'll be buying these shares. Let me go ahead and share my screen and we'll get right into this. So Alphabet stock is going to split and it may trigger retail buying. Gee, you think? It's $2,860 a share right now. We're not exactly piling into this thing, but after it splits 20-for-1 and it's trading at roughly $140 a share, yeah, we'll get into it. And the reason is that one would much rather spend $100 and own 100 shares than to own 0.1 of a share. So we observe lower retail participation in high price stocks than in low price stocks. Retail buying surged in the wake of both the Apple and Tesla stock split announcements, analysts at Vanda Research said. When Apple announced its 4-for-1 split in July 2020, retail investors went from purchasing less than $150 million in Apple each week to nearly $1 billion a week in Apple. After Tesla's 5-for-1 split announcement in August 2020, retail buying jumped from $30 to $40 million in shares per week to over $700 million a week in shares. Alphabet's announcement will almost certainly end up increasing retail investors' activity in the stock. And why is that important? Well, it's important because Alphabet right now is kind of criminally undervalued. And don't worry about it. We retail investors will fix this, but these banks aren't doing anything about it. And so when you're trading at $2,860 a share, it's basically big money's in control of this thing, but we'll fix all that. So it's trading at $2,860 a share. It's got $112 earnings per share and a price per earnings of 25.5. And I'll get into in a second why that's undervalued. So if we take a look at a calculator here, just a quick review of how to derive the price to earnings. You say 2860, and if you divide that by the $112.23, you get your price per earnings of 25.5. Now I believe that this stock will go from a 25 price to earnings, and then when we get a hold of it, and especially with the hype of the split, it's going to go to 35 times earnings and possibly even 40 times earnings. But more realistic, 35 is where it should go to. So what does that do for this stock price when it goes to 35 times earnings? And why am I so convinced that that's going to happen? I'll get into that a little bit later. So let's say it goes to 35 times earnings. 35 times $112.23 equals $3,928 a share. It's currently trading at $2,860 a share. So what would the increase in price be on this? What sort of boost are we talking? Just to go from a 25 PE to a 35 PE. Let me see here, 2860. A 37.3% increase. So every dollar that you invest in this stock, by my count, will get you $1.37. So I plan on buying 10 shares of Google, and that would give me 200 shares. And so let's see what the profit would be on that. So right now, 2860, divide that by 20, would get you $143 a share. 39.50 divided by 20 will get you $197 a share. So that's about a $54 difference. 54 times 200 is $10,800. That's $10,800 on a $8,603 the 37. So $10,800 on $28,603 investment. I'd say that's pretty good. And that's by July. And let's face it, what is the stock market going to do between now and July anyway, except for go up and down and up and down and do like a whole lot of nothing? So I think it's a pretty good place to store my cash in the meantime. And I was actually going to do like a Let's Play earnings next week on Cleveland Cliffs, but then when I saw this pop up, how can I pass up on what I believe is going to be easy money? And let me show you why. Historically, Google trades at a price to earnings ratio over the last 5 years on average of 33.8 with a median of 31. It's currently trading at 25, as we just noticed. A couple weeks ago, it was trading at 22.5. And that's because the big banks are the ones that are keeping this multiple nice and low, because we're not getting to this stock yet. If we were getting to this stock, it would trade closer to Microsoft or Apple. But we're not in control of this one. At the pandemic low was trading at 21.48. It's barely above that now. I think that when we get a hold of this, it'll probably trade closer to 35, like through here. And this is before it like actually really, like the price went right through the roof. It was trading at 39, 51, 60, 43, and that sort of thing. And the difference is, let's look at the time here. So this is 2017, October 17, January 18, May 18. And if we look at the price of Google back then, it was far less than it is right now. Now, it wasn't cheap. Don't get me wrong. It was $926 a share. There aren't too many stocks trading at that price. It was $1,000 a share. But at least it was doable. We were able to get in there, maybe trade options on it. Let's see what a Google option, if you want to trade for one of those right now. Let's say I want to trade an option on Google. And let's say a call option. This would be a little bit in the money. And let's put it out there. Call options, you want them a little bit further out. You don't want too near term. When you're selling them, you want them near term, but when you're buying them, you want them pretty far out. So let's say you're selling this one, $21,450 for one option. Do you think a lot of us are buying options? Now, buying an option gets you in control of 100 shares of stock. Now let's go ahead and say 21,450. Let's take a look at Apple. Now, Apple and when after Google splits, I expect it's going to be about the same price as Apple is right now. So let's see what a call option on Apple that expires in June 17th. That's slightly in the money. $1,370. That's a lot more doable than $21,000. So people are actually buying this. They don't mind paying this and getting control of 100 stock shares of Apple. It's why Apple trades so many shares. It's not that everybody's going in and buying one more share than we used to own. It's that they're buying 100 shares for a lower amount of money, and that's what boosts the volume on these stocks so high. And I expected Apple or Alphabet, as soon as it splits 20-1, is going to get a much higher volume due to options. Plus, a lot of us retail investors are going to hang on to it. And when you look at the price of, say, Google, and you see it's trading at 25 times, let's take a look at some other stocks. How about Costco? Costco's trading at 44 times. It's a great company, but it shouldn't be worth double Google, almost double. It's a great company though, but come on. You don't see analysts going on television talking about how overpriced Costco is, right? How about Nike? Nike is trading at 38 times earnings. Google's at 25. Again, it's a good company, but if they go on there, they're going to say, these analysts on CNBC will say, hey, well, Nike's a great brand. It deserves a premium valuation. Same with Costco. Costco is a great brand. It's the premier big box retailer in America. It deserves a great valuation. Well, Google deserves an amazing valuation. I'm going to show you why in the numbers here in a second. But Google's a premier company. It's a monopoly. If you get a Windows update, it comes up and all of a sudden your homepage is Bing. What's the first thing you do? You change your homepage to Google. Google's a monopoly. It's the reason why it's the advertising giant on this planet. YouTube is a monster. Their search engine is a monster, and the Google Cloud is also growing in its revenue share and in its market share. And so this company is an absolute beast. If we take a look at Google's 10Q, you can see that it's growing at a really a remarkable amount. For a company this large to grow from 161 billion to 182 billion to 257 billion, that's incredible. This is a 41% increase from here to here, and from 182 to 257. This $76 billion in net income, it's 30% profit margin right there. This 40 billion on this, that's a 21% profit margin. And again, 21% here. So Google is a company that's growing at a rapid rate, has a huge profit margin, and you know what? These things matter. When you take a look at some of these other companies, say like a Nike, well, let's go with Home Depot. Home Depot is a fantastic company. Home Depot trades at the same exact multiple as Google does right now, and it's a great company. It's rated an A by Schwab. But when you look at its statement, it doesn't grow like Google. Although this from 110 to 132 is pretty good. That's about 20%. But 108 to 110 and 100 to 108, 94, that's about 8-9%. Its operating margins, let's see, 132 billion. What's their net income? 13 billion. So that's about 10%, 132 to 13. How about 110? That'll probably be about 10 or 11. 11. So it's 10% profit margins and about, this is a great year, 20%, but we'll say normally about 10% growth. 10% growth, 10% profit margins. We're talking about a company that has 40% growth and 30% profit margins. And these things matter. But why does it matter? Let's take a look. And what is my plan? So my plan for Google is I plan to buy 10 shares, and that will get me 200 shares post-split. And then when I turn on CNBC and Google has gone from 25 multiple to a 35 multiple, and we're watching analysts on CNBC taking nitroglycerin live on television because they can't believe the way that this stock has exploded in valuation, given that it hasn't done anything except for a split. Why has it gone from 25 to 35? And they're not going to mention that it's the premier advertiser in the world and the growth and all that stuff. They're not going to mention that Costco's overvalued or Nike or whatever. They're not going to mention any of this stuff, but their heads are going to explode. And when that happens, I'm selling half. I'm not going to sell it all. I'm going to sell half, and I'm going to take half my profit, but I'm going to keep half because I'm an investor, and I'm going to keep that half. And the reason why I'm going to do that is because let's say that Google trades at, let's say it increases 20%. You know, it goes from 40% one year or 39 or whatever it is last year, or no, 41% to 20%. So if we multiply 1.2, so 20% times the price per earnings, 0.23, and this is why I'm not going to sell my other half. That would be $134.67 a share, the earnings per share. Now this is on a pre-split adjusted basis. And so at this price of $28.60, and you divide that by $134.67, you're talking about a PE of 21.23, 2023, 1 year from now, lower than the pandemic lows. A price per earning lower than the pandemic lows on a company at this point growing 20% with a 30% profit margin. So this company, to me, is criminally undervalued. And so, yeah, I'm going to be buying. I've already started buying it. I've got 7 shares already. I'm going to build out my full position, and I'll be up to 10 by the time the split happens. The split happens on July 15th for shareholders that were holding the shares as of July 1st. So if you got anything out of this video, please like, subscribe, hit the little notification bell, and until next time, we'll see you. Have a good day.